gold hit $5,595 per ounce on January 29th, 2026. That was its highest price in recorded history. By late March, it had fallen to $4,250, a 23% crash. In less than 60 days. Here is what is strange about that crash. The Iran war was ongoing, oil was at $100, the Federal Reserve was paralyzed. The incoming Fed chair had already signaled rate cuts were coming. The structural conditions that every major bank cited to justify a $6,300 year-end gold target had not changed by a single data point. And yet, gold fell 23%. Most investors read that crash and concluded that gold had failed the test. The war started. Gold didn't perform. The thesis is broken. The correct reading is the opposite. The crash did not break the thesis. It created the entry window that the thesis requires. This is for educational analysis only, not investment advice. Please consult a qualified financial advisor before acting on anything discussed here. But before we get to the entry window, you need to understand what is actually happening on April 29th. Because April 29th is not just another FOMC meeting, it is the last FOMC meeting Jerome Powell will ever chair. And the decision embedded in that meeting, not the rate decision, everyone already knows. The rate decision, the structural signal embedded in that meeting, is the most important monetary signal for gold in the next 12 months. Gold already priced it. Most investors haven't figured out why. Here is exactly what is happening on April 29th. The Federal Open Market Committee will hold interest rates at 3.5% to 3.75%. The CME FedWatch tool currently prices the probability of that outcome at approximately 99%, not a decision, a mathematical inevitability. Jerome Powell will walk to the podium for the last time as chairman of the Federal Reserve. His term expires on May 15, 2026. Kevin Warsh, nominated by President Trump on January 30th to replace him, is scheduled to assume the chair 2 weeks after that press conference ends. Powell's final statement. Powell's final press conference. Powell's final acknowledgement that the Fed cannot cut, cannot raise, and cannot explain its way out of the trap that oil at $100, inflation at 2.7%, GDP growth that collapsed to 0.7% in Q4 2025, and $9.2 trillion in maturing Treasury debt have constructed around it. The number you need to understand is not 3.5% to 3.75%. It is not even the 99% probability of a hold. The number you need to understand is 5. 5 is the number of consecutive FOMC meetings that have featured at least one dissenting vote. The last time the Fed had 5 consecutive dissents before 2025 was over, 36 years ago. The committee is not unified. The committee has not been unified since October. And, in exactly 2 weeks after Powell's final press conference, a new chair will sit down and run the institution for the first time. That transition from a Fed chair who built his legacy on data dependence and patience to a nominee whose analytical framework aligns with a president publicly demanding rates at 1% or lower is the structural event that gold is pricing right now. Not the April 29th rate hold. The regime change that the rate hold confirms is real, is unresolved, and is about to be handed to a new steward. Let me say precisely what the April 29th meeting reveals, because the surface story and the actual story are completely different things. The surface story is that the Fed held rates. Oil is high. Inflation is elevated. The Fed can't cut. Nothing has changed. The gold thesis is on pause, until macroeconomic conditions allow the Fed to move. The actual story is that the April 29th meeting represents the terminal data point in Powell's tenure, the moment when the market can fully assess what he is leaving behind and what Warsh is walking into. What Powell is leaving behind: rates at 3.5% to 3.75% against an oil, shock-driving inflation above the Fed's target, $9.2 trillion in maturing Treasury debt that must be refinanced this fiscal year, at rates that are already costing over $1 trillion annually in interest payments, $245 billion in cumulative losses on the Federal Reserve's own balance sheet, losses that the Fed legally classifies as a deferred asset because it writes its own accounting rules, and an institution that has made $40 billion per month in what it calls reserve management purchases since December 2025, which is quantitative easing under a name carefully chosen to avoid the word printing. What Warsh is walking into: every one of those structural conditions, plus a divided committee, plus a president who has publicly demanded 1% rates, plus a Department of Justice investigation into his predecessor that a federal judge said had essentially zero evidence of any crime and was motivated primarily by pressure to cut rates. The number you need to understand is not the rate decision. The number you need to understand is 12 months. In every historical Fed chair transition during a period of monetary stress, the 12 months following the transition have been the most volatile for gold. Not because the new chair immediately changed policy, because the market could no longer predict what the institution would do with certainty. And when the market cannot predict what the world's most powerful central bank will do next, gold prices what it expects and what it has consistently expected for 3 years, which is eventual debasement. The April 29th decision has 3 components that most commentary will not explain clearly. First, the rate hold itself. This is not a neutral outcome. The Fed projecting only 1 rate cut for all of 2026, while oil trades at $100, while core inflation is forecast at 2.7% for the full year, and while GDP growth collapsed to 0.7% in the fourth quarter of 2025, means the Fed is holding rates in an environment where real economic activity is deteriorating faster than inflation is. That is not stable. That is the definition of stagflation, the monetary condition that is historically most bullish for gold over a 12 to 24-month horizon, because the central bank cannot fight inflation without deepening the recession, and cannot fight the recession without deepening the inflation. Second, the DOJ dimension. Powell confirmed at the March 18th press conference that he will not leave his Board of Governors position, which technically extends until early 2028, until the DOJ investigation against him is well and truly over with transparency and finality. Senator Tom Tillis has publicly vowed to block Warsh's Senate confirmation until the DOJ investigation concludes. This means Warsh's transition may be delayed. Powell may serve as chair pro tem past May 15th. The institution may have no confirmed chair during one of the most structurally complex monetary environments in 40 years. That institutional vacuum is a gold signal, not a footnote. Third, and most important, Morgan Stanley's chief U.S. economist has already said publicly, "We're still on June and September for rate cuts explicitly framed as cuts that will come once Powell departs." The market is not waiting for economic data to change. It is waiting for the change of personnel. When that language is coming from Morgan Stanley, the institutional signal is that the rate cut cycle that gold has been pricing since 2023 is not dead. It is scheduled. It has a new management team assigned to it, and April 29th is the last meeting before that management team takes over. Gold's 23% crash from $5,595 to $4,250 was mechanical, not structural. Let me say that precisely. The crash was produced by four forces acting simultaneously. Geopolitical risk premium overshoot that partially deflated when a worst-case scenario did not immediately materialize, dollar strength, with the DXY reasserting above 108, rate cut expectations evaporating as oil inflation made the Fed's path harder to read, and cascading margin calls from leveraged long positions at historically elevated levels. Every one of those four forces is mechanical. None of them changed the structural case. The structural case is this. Central banks bought 863 tons of gold in 2025, double the historical average. The World Gold Council projects approximately 850 tons in 2026. China's People's Bank of China has now extended its gold buying streak to 15 consecutive months, with reserves above 74.19 million ounces. These are not speculative positions. Central banks do not buy gold on leverage. They do not get margin calls. When a central bank adds gold to its reserves, that gold does not come back to the market during a short-term price correction. Gold recovered from its March lows. As of April 2nd, 2026, it is trading around $4,758. That is a $500 plus recovery from the March trough. The mechanical sellers have been exhausted. The structural buyers have not changed their behavior. And April 29th is approaching as the institutional community begins pricing what the post-Powell monetary regime will look like. Warsh is widely characterized as a hawk, someone who historically favored higher interest rates over the risk of inflation. His voting record during his time on the Federal Reserve Board from 2006 to 2011 supports that characterization. But Warsh in 2026 is not Warsh in 2008. He has made numerous public statements in recent months favoring lower interest rates. He was nominated specifically because the president believes he will cut rates, and the structural arithmetic he is inheriting makes a strong case that rate cuts are coming regardless of his preferences. Here is the arithmetic. The United States must refinance $9.2 trillion in maturing federal debt this fiscal year. At current rates of 3.5% to 3.75%, that refinancing is already costing $1 trillion annually in interest payments, more than the entire defense budget. If Warsh cuts rates, that interest cost falls and the economy gets monetary stimulus. If Warsh holds rates at 3.5% against 0.7% GDP growth and rising unemployment, the recession risk that Moody's is already pricing at 49% probability becomes the dominant story by Q3. And if Warsh raises rates to fight oil-driven inflation against a $36 trillion debt load, the refinancing cost of that debt increases by tens of billions of dollars for every 25 basis points. Every policy path leads to a condition that historically supports gold. Rate cuts produce monetary debasement signals. Holding rates through a recession produces flight to safety demand. Raising rates into a debt crisis produces the kind of credibility event that has historically sent gold to its most extreme gains. This is the wild card. Not which direction Warsh moves first. The wild card is the market's realization that there is no policy path that resolves the structural tension without benefiting gold over a 12 to 24-month horizon. Go back to 1,900 1979, Arthur Burns had spent years as Fed chairman, accommodating inflation through a period of oil shocks, political pressure, and monetary compromise. By the time he was replaced by William Miller in 1978, and then Paul Volcker in August 1979, the Federal Reserve's credibility was at a structural low. Markets did not know what the new leadership would do. Inflation was at 11%. Oil had surged over 110% during the Iranian Revolution. Here is what gold did in that 1-2 month window of transition and uncertainty. From August 1979 to January 1980, gold rose 276%. Not gradually, not steadily, in violent concentrated moves that rewarded investors who understood the structural case and punished investors who waited for confirmation. The historical parallel to 2026 is not precise. No parallel ever is. But the structural shape is identical. In 1979, an outgoing Fed chair with a legacy of accommodation, an oil shock, inflation above the Fed's implicit target, a divided institutional response, and a new chair entering with an unknown policy trajectory. In 2026, an outgoing Fed chair leaving amid a DOJ investigation, an oil shock, inflation above the 2% target at 2.7% forecast, 5 consecutive meetings with dissenting votes, and a new chair entering with a policy mandate from a president whose stated preference is 1% rates. There is one critical difference. In 1979, Paul Volcker had the institutional independence and the personal willingness to raise rates to 20% to destroy inflation, regardless of the political cost. The economy entered a severe recession. But gold collapsed after that because the monetary authority demonstrated it would prioritize price stability over growth at any cost. In 2026, the arithmetic does not allow a Volcker-style response. You cannot raise rates to 20% against $36 trillion in federal debt. The interest cost would exceed the entire federal discretionary budget 5 times over. The Volcker option is not available. And gold's structural case is strongest precisely in the environments where the Volcker option is unavailable, where the central bank must eventually choose debasement because every other path leads somewhere worse. 2 types of investors are looking at the April 29th meeting. One type sees a Fed hold. They see gold that peaked at $5,595 and crashed to $4,250. They see a commodity that failed to hold its gains, an institution that is paralyzed but still functioning, and a situation that requires waiting for clarity before acting. They will not move until the Warsh era produces a specific, confirming catalyst, a clear rate cut, a clear dovish signal, a clear monetary event they can point to. By the time that clarity arrives, Wells Fargo's $6,100 to $6,300 year-end target, JPMorgan's $6,300 target, and UBS's $6,200 target will have already distributed most of their structural gain to investors who understood what April 29th actually signaled. The other type of investor reads the same data differently. They see a 23% mechanical drawdown from an ATH that has now partially recovered to $4,758. They see central banks that bought 863 tons of gold in 2025 and are projected to buy 850 tons in 2026. Buying that does not stop during mechanical corrections. They see a Fed chair exiting under a criminal investigation with a divided committee and a successor whose first monetary decision will be made against a backdrop of 0.7% GDP growth, 2.7% core inflation, and a $9.2 trillion refinancing wave. They see a 1-2 month post-transition window that every historical parallel says is the window where gold delivers its most concentrated structural gains. They understand that April 29th is not a catalyst, it is a confirmation. A confirmation that the monetary trap is real, that the resolution of that trap requires eventual debasement, and that the investors positioned before the transition, not after, capture the structural move that is already being priced into institutional forecasts at $6,100 to $6,300. The 1,979 investors who understood the structural case turned $10,000 into $37,600 in 12 months. Not because they predicted Volcker's specific moves, because they understood that the transition window between an outgoing chair and an incoming one in a period of oil-driven inflation and institutional credibility uncertainty was the most structurally loaded moment in the monetary cycle. The April 29th meeting will produce a rate hold. The press conference will produce careful language. Powell will answer questions about oil, about Warsh, about the DOJ, and about the path forward with the measured precision of a man handing off an institution that he knows is in a more difficult position than when he arrived. The market will deliver its verdict not on the rate decision, but on the structural signal embedded in everything that is being left behind and everything that is about to begin. Gold at $4,758, recovering from a mechanical correction, with institutional year-end targets clustered between $5,400 and $6,300, with central banks buying at double the historical average, with the most significant Fed transition in a generation 16 days away, is the structural setup, not the confirmation event. April 29th is when the confirmation arrives. Now you know.